Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark comments on the Shanghai stock market meltdown and how unpopular gold is with investors. Schachter Asset Management President Josef Schachter tells us what he thinks crude oil will do and how Alberta's socialist government is working out so far for the energy sector. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Well, it's nice to be with you, and it's nice to have a bit of a breather at the end of the week. There's been a fair share of volatility this week.
And the most volatile market was where?
Well, it was the far side of the ocean in China. The equity markets there, as we know, just went on a vertical run into the middle of June and turned on a dime. And when they did, the margin calls started to kick in. We've had a series of exchange halts. We've had a series of individual stocks being halted. The powers that be offering just boatloads of money, billions and billions of dollars to the industry to help support the prices. But the bottom line is that when markets have excesses like this, that's to me when the technicals really stand out and give you a bit of guidance. So we took a look at this type of a bubble as it would compare to other bubbles. So we don't have a lot of data from the SOC bubble of 1720. But once we get out to 1929 in the Dow, or 1980 in the gold, 1989 Nikkei, or the 2000 NASDAQ, there's a lot of work that we can do to look at the backside of the bubble. And typically, you're going to look for a 38 to 50% retracement, and the Shanghai market, after it all sort of unwound this week, had given back 55% of the gains for the last year. It kissed right onto its 200-day moving average, which is the same type of this thing that we saw in the NASDAQ 2000, similar to what the Dow did in 29. So the characteristics for the first good supporting low to get a turn seem to be in place. I had been thinking anything from about 3,800 down on Shanghai would be a good support. It turns out that 3,400 is where we got to as the ultimate spot. The key here is that once you put that low in place, is that the final low? And in most cases, it's not. What you have is a good relief rally. It would tend to last 10 days or more and retrace a good 40 to 60% of the move that you have off the high. So just putting a scenario out here, would appear somewhere at the end of next week, the beginning of the following week. Look for the sort of 4,200 to 4,400 level for the Shanghai market on the bounce. It probably has a bit of trouble from there. For anyone North America looking to participate in these in that market, there are options, and they trade in New York on the ETFs there. So there's liquidity and availability to take advantage of it.
Now, of course, in China, they just allowed people to put their houses up as security to buy securities. Is that a good idea?
Oh, Jim, let's not go there. No.
I know somebody said, Jim, that's
the ATM, the U.S. had their house as the ATM right through the early 2000s. But we're not going on that one. Let's go. Okay. So from Shanghai, let's go on to the currencies here. U.S. dollar.
And the U.S. dollar, of course, is where everybody runs when they think times are about to turn bad, right?
Well, that's right. And we saw some action. You'd also expect to see a little bit of action into precious metals. Both of those really didn't have the spark that you would have expected. the early part of the week, a little bit of strength in the U.S. dollar. It got up and tested some very good, one very good resistance line that we've got. It's now a 4-point resistance line coming down from the highs. And we've been in this consolidation pattern for the U.S. dollar index just long enough. I was thinking that, we would stretch into the summer before it would be capable of a breakout. And the index itself sits at this point right around 95, and the support is both a Fibonacci retracement that we would look at around 92.60, as well as the 50-week moving average, which coincidentally has now managed to catch up to that same 92.5 level. So I would say if this consolidation lasts much longer, we're going to be ready for the breakout. On the upside, if the index does start to go, I think one would want to get on board. The Canadian dollar, another currency that we like to keep our tabs on here, has been right back down to the lows of the year. That pretty much coincided with crude oil making it down to $51 this week, and the Canadian dollar now starting to give some short-term oversold readings, the type of things that we saw in the bear markets of the early and late 90s and back in the 80s. And you'd expect to see, I would say, an interim low probably next week, maybe a bounce for a week or two, but then reassert the trend back to the downside.
Are we going to see a 62-cent dollar again?
Yeah, I have learned to never say never about any price level. And for all that 62 cents was part of a time when Canadian budgets were, very, very much into deficit situations, and there was concern regarding the solvency of the various, or all the provinces. I'd be surprised to see that type of a number. Something into the low 70s would be realistic, I would think.
Ross, what's happening with the S&P 500 index?
An extremely volatile week, up and down day after day, with the exception of Friday when the market finally opened well and then managed to continue its gains through the balance of the day. Most of the week was just the opposite. A poor opening became a strong close, and likewise a strong opening became a poor close. But getting away from the day-to-day action here, I think one needs to see just what level the sentiment has reached here. We take a look at the put-call ratio of the equities market, individual equities, not the indices, and it's reached an extreme early in the week, so that it's at a level we've only seen 10 times since the market bottomed in 2009, and better than half of those resulted in lows from which the market then made multi-month rallies. The other examples at least saw a test of the high. We also look at what's called the Fear-Greed Index. That takes a series of different indicators similar to the put call, and clearly it shows that investors have become panicky. Fewer than 1% of all the days since 1998, since the implosion with long-term capital in 1998, only less than 1% of the days, as I say, are at levels that have been seen as of this week, and returns in the coming periods have been positive in most instances. And when we take a look at real money in terms of cash flow, the Ridex family of mutual funds keeps some good studies. One of them they call the beta index, which collapsed to 0.01, meaning that investors were at least 9 times more likely this week to move money into safe funds than into risky funds. So, and that type of a shift, we've only seen that 5 times in the last 15 years. Very infrequent, and it tends to precede volatile market rallies over the next couple of months. So, we take a look at the markets as they are right now. I have one of my own little springboard indicators that kicked in signals this week on a weekly basis, also suggesting that we could bounce pretty well. So, maybe the hard sell-off we've had wasn't as hard as it could have been around the Greek and Chinese situations in the last 2 weeks. But maybe the summer rally is just about ready to perk up.
Ross, thanks for being on the show.
As always, it's a pleasure, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. You can email any comments or questions to him at ross.clark@cibc.ca. Coming up next, Josef Schachter on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
I guess it's Josef Schachter, president of Schachter Asset Management Incorporated, online with us from Calgary, Alberta. Welcome to This Week in Money.
My pleasure, Jim.
Well, currently, are you bullish or bearish on the crude oil market?
Well, since our last conversation when I was bearish, I haven't changed at all. I think the price, of oil now is just under $53 for WTI. We had a bounce from, the low in March of 42 to, the low 60s. And, OPEC looks at what's going on in North America, and production is not coming down. U.S. production this week rose again. And, they want to knock off the high cost, oil. But what's happening is costs are coming down in the industry. Drilling costs are down 15-20%. Land costs are a lot cheaper. So the industry has driven their cost structure down so that they can make money in, the $50-$60, price range for oil for U.S. pricing. And so I think OPEC is going to have another round of increasing production where there's comments this week that Saudi Arabia is raising production. Iran is going to probably have a deal with the U.S. on the nuclear issue, and they're going to come on with, 500,000-600,000 barrels a day, more production. The big problem is demand's about 92.5 million barrels a day. And, the world, non-OPEC production, 58, 59 million, depending upon, the time of year, is runs full out. And so the difference, the balance, which right now is about 28, 29 million barrels, is, because there's liquids of another 5 or 6. The call on OPEC is maybe 28.5 million, and OPEC's producing, 31.5, 31.6. So we have, 2.5 to 3 million barrels a day of excess capacity, depending upon the time of year. So that's been building up in inventories, and the U.S. again had a big built-in inventory this week, 11 million barrels. So we're getting to the point where there's not a lot of storage on the oceans in terms of, large crude carriers. The storage facilities like in Rotterdam are full up. We're almost full up in the United States. China is getting close to full up. And so, if you're having 3 million barrels a day of excess capacity and you get past the summer driving season and you have the shoulder season in the fall, and then all of a sudden Iran comes on with another 700,000 barrels a day of excess capacity, I think we're going to see weaker prices. I think we're going to go down probably to the lows that we saw in March of $42 for WTI. And it's possible if we see disruption in Europe with all the problems that are going on there, and if Asia continues to have problems, especially China, and we see the U.S. dollar rally, the U.S. dollar is trading around the 96 level. If that rallies and goes above the 100.71, which was the yearly high, which implies the euro going from 110 down to maybe par, then it's possible that the price of oil goes even lower than 42. So I'm in the bear camp. I think OPEC is producing way too much. They want to drive out high-cost non-OPEC production. They did not succeed, when they had the move from the second quarter of 2014 to the first quarter of 2015. And so now they're going to have to, take another big move. And with the excess production that they've got now, at some point storage fills up, and then the day of reckoning comes again.
So with that kind of a price mode taking or facing the industry in Alberta, what does that say for the local crude market?
Well, again, one of the things that will happen is the Canadian dollar is going to go down. We may see 75 cents. We may see 72 U.S. So the industry, if the price of oil is, 42 U.S., is still, making reasonable amounts. So what they're trying to do is drive out, stripper oil in the United States, which in the $40 U.S. pricing doesn't make money. Stripper oil is wells that are 5-10 barrels a day, so they're kind of old, tired wells that are still producing. And then you get into in heavy oil in places like Venezuela, Colombia, Mexico, that at $40 doesn't make sense. And then the UK North Sea, a lot of oil there needs more than $60 a barrel. And then you come into Canada, and if we see below $40 WTI, we're going to see maybe some of our heavy oil get shut in. So, if OPEC pushes this, they could succeed in driving out 1 million or 2 million barrels of non-OPEC production. And once that happens, then at that point, supply and demand heading into winter 2015, 2016 would be more in balance. And we could see at that point a recovery. I don't think we're going to see more than, $70, $80 in winter 2015, 2016. And it's going to require a year or two of underinvestment. See, the problem with the industry is when the times are good, the industry overinvests and spends 2, 3, 4 times cash flow. And from 2009 to 2014, there was also a lot of money because of quantitative easing, that a lot of private equity money came in, a lot of debt money came in, a lot of money came in preferreds. And normally, you don't mind debt money when you're building facilities so that you have a big gas plant or an oil battery or pipelines and stuff like that, so you don't mind borrowing debt for that. But companies were borrowing debt to drill exploration wells. And of course, that kind of debt was hard to service when you have, number one, maybe not success with the drill bit, and number two, not success with the price of oil being able to service the debt. And that's why we're seeing a lot of companies that are debt-laden in Canada, and even in the United States, there's been some bankruptcies already. Many of them, which are debt-laden, have either had to sell assets aggressively to get their debt holders on side, or they're having the living dead praying for higher oil prices, which of course haven't happened.
And do you think they have a chance for higher oil prices given the fact, everybody's forgotten about Iran being a producer because they've been off the market for so long?
Well, Iran has been able to sell oil to places like India, China, Korea, and Japan, even with sanctions on. So there is markets for their oil already, and there are refineries around the world that can take their quality of crude. What's going to happen is, of course, they're going to come on the market and try to get back some of their traditional buyers in Europe and other places. I don't believe the U.S. will be buying a barrel of Iranian oil because, number one, they don't need it because North America is self-sufficient. Canada exports to the States, and the imports are mainly now from Canada. They do some from Nigeria, some from Africa, and really Saudi Arabia, I think, is the only producer that sells to the United States right now. So Iran coming on the market, and if American Congress doesn't remove sanctions, it doesn't matter at all. It matters if Europe is willing to buy their oil, and they've got 70 ships fully loaded with crude, so they have over about an average of 1 million barrels per ship, and they're waiting to just get the go-ahead as part of this sanctions deal removal. And if the headlines from today are saying that a lot of progress has been made, so potentially within a week or two, if the U.S. signs off and Iran signs off on it, Iran could say, done, turn on the engines and find a market. So to me, the glut, worsening by Iran is going to have to put Saudi Arabia in an issue. Do they want to lose market share to Iran, which is their enemy, the Sunni Shiite conflagration around the world? And so I think, Saudi Arabia may just, which we've heard this week evidence of it, they've lowered their price for Saudi crudes into Europe so that they don't lose that market share to potential Iranian customers.
Do you see oil stocks continuing to underperform the commodity as they have in the past number of weeks?
Yeah, like the TSX oil and gas index is 196. The 52-week low was 187.59. That was in the second week of December when we had $52 oil, but we had a lot of tax loss selling, and especially in the companies that were the dividend models and also those that were oil sands related. We had a lot of tax loss selling then, and that was when you got to that 187. Well, we're 196 today, and if I'm right that the price of oil comes down another $10, we're going to bust below that level, and we may go down to the levels we saw during March of 2009, which is the 170 level. 174, I think, was the exact number. And if we go down there, that's implying that we have potentially another 15-20% downside. So we've been recommending to investors to stay on the sidelines. Find the names of the companies that you like, be it large cap, Suncor, Crescent Point, whatever, and just wait for the right buying opportunity, because prices will continue to head lower. Like even today, when we had this, moderate decline in the index, and a price rise in oil, we had a 1.3% decline in the TSX oil and gas index. And, some of the service-related stocks were down almost 7%. An example like Trican was down 24 cents to 3.32. So the market was, is beating up, each day different names. Even Imperial Oil, I think, was down 2%. Normally you don't see Imperial Oil go down that much.
Are the name brands in trouble?
I don't think the individual companies that are the larger names are going to be in trouble. I think their stock prices are, will hurt. A lot of the big cap companies have very strong balance sheets. They have very good long-term core assets. But you can't fight a lower oil price. And so if the price of oil comes down by, $10 from where you are today, that's 20% probably. The stocks will deteriorate. What investors should do is get a shopping list together of the names they want to own, be it dividend model names like Crescent Point, or large cap like Suncor, or more smaller cap entrepreneurial names like Tamarack or Delphi. Have the buy list ready, and when this thing shakes out and the fear level, picks up, and then I would, and my guess is look for pricing in the low 40s, and if we haven't seen the U.S. dollar break above that par 71, and the euro hasn't gone, below 107, then that might be the bottom. If the U.S. dollar has broken out and gone up even more, then it's likely we may even see low to mid 30s for the price of oil. And one thing there's an index out there called the S&P bullish index, oil and energy index, and it's and investors can go look it up and Google it. And that index right now is trading. Let me pull out the numbers for you today. That index is trading right now at 30% bullishness. Historically, at market tops, it trades over 80% bullishness. At market bottoms, it trades under 5% bullishness. So if you look at what happened in December of 2014, it was trading down at 4%. If you go to 2009, when we had the March bottom, it traded at 2% bullishness, and the close yesterday we were 30%. So we still have quite a bit of downside, but once you get down below 10%, you want to get your buy list ready and be ready on any bad days, on any down days, once you get down to a very low bullish consensus, to just nibble away, and then, over a period of days on declining market days, just buy. Because I think there will be, once OPEC wins this battle and high-cost production is removed, when the recovery happens, the oil and gas companies aren't going to go into a spend like crazy mode again. They're going to say, okay, we survived another tough time. Let's take our money and rebuild our balance sheet. Let's go and spend money on our core areas where we have low costs. And they're going to be, in a kind of a defensive mode in the first phase of the new bull market. And then once, of course, the price sustainability is better than $80, and they have a comfort zone, then they can use hedging, and then they can get aggressive and start growing again. So, usually these oil and gas cycles have 3 to 5 years in them on the upside, and when we have bear markets, you can have them for 1 or 2 years. So our peak in this cycle was the second quarter of 2014. We may see, a bottom sometime in Q1, Q2 of 2016.
We're speaking to Josef Schachter, president of Schachter Asset Management Incorporated in Calgary, Alberta. Joseph, will oil stocks hit a point where they're just going to be an absolute bargain in the near future?
Well, near future, we're early, mid-July, so, early July right now. My view is, if you remember last year in December, during the tax loss selling season, in the second week of December, we had bargains galore, and we were very bullish then. We wrote a major piece for our institutional clients saying that it was going to be a great buying opportunity, which it was. And then sometime during the second quarter of 2015, of course, the stocks had reacted very nicely, and the price of oil was starting to, show signs that it was going to reverse and go down again after the recovery from that 42 to 62 level that happened during April, May. So from May on, we've been in another, negative phase. My view is that negative phase probably lasts into fourth quarter. And if we get a bottom, tied to tax loss selling like we did last year, that could be the next major buying opportunity. And investors should, have their buy lists ready. And then on any, real shakeout in the sector, but be it the price of oil and the stocks and tax loss selling all come together, usually that gives you a very, very nice window for buying. And investors who take advantage of that can see significant upside. Again, just look at the charts on individual names that your favorites are, and just see where they were in second week of December 2014, and where were they in the second quarter 2015, and you can see, my God, those are great returns, and that's the potential again if we see the same kind of shakeout into the end of the year.
Have the seasonals for the high and low points for crude oil changed because of fracking?
I'll pass on that one. I really don't know. I think the fundamentals of the oil and gas industry are one where, from my point of view, is it's an industry where it goes from underinvestment and you have low prices to a period when prices recover, and then there's massive overinvestment. And so it's a cyclical one, just like copper or any other major commodity. You look at cattle, as we were talking earlier in the beginning. Right now cattle prices are very, very high, but supply is very, very low. So anytime you have a cycle, you're going to go through these periods of underinvestment, overinvestment, underpricing, overpricing, and we're now heading into a period of underinvestment, significant underinvestment, and of course we're going to need to see much lower prices to force the production down. So when the depletion kicks in, remember a lot of wells have high decline rates, especially the new wells that are fracked. But what's surprising to a lot of people, including myself, is that with all of the slowdown in drilling from over 1,600 rigs to half that now, you were still seeing U.S. production holding up, because a lot of wells were drilled prior to the slowdown, and they were waiting to complete them, and of course, they didn't do it when the prices were falling. But with prices being in the 50s, companies are saying, well, the incremental cost is only the cost of completing and fracking the well, and we get all of this volume coming on. And so we're seeing production continue to rise for natural gas, as well as for oil and as well as for liquids. And until we see the industry have production declines that are material, I don't think OPEC is going to stop dumping too much oil on the world, because they want to knock off the high-cost non-OPEC production. The
refiners have performed the best in the sector. Are they getting fully valued?
Well, they've done better because they have the R&M business is very good now. I don't know what the pump price is in Kelowna, but it's we're here paying 108, 109 in Calgary. And so you look at the price of oil and you say, why is it here? It should be 20 cents lower. And it's really the R&M business has become where they make their profits. If they can't make it in the upstream producing it, they're going to make it in the refining side. And we have less refiners in Canada. There's less competition in Canada. And so, I know a lot of people in Vancouver head south of the border to fill up their tanks and probably get a 40 or 50% cut in the price to fill.
Oh, yeah, because we're looking at $1.40 quite often on some weekends.
Yeah, that's pretty nasty, yeah.
Although we do pay the highest gasoline taxes in Canada, too.
Well, I better not say anything. Our new premier may want to raise the price again. The local media has been writing about a meeting that was held yesterday, and she seemed pretty positive about, the way she's going to go about it, and that she's not going to be doctrinaire. There is a bit of optimism that the NDP is not going to be as confiscatory as was feared when they took over and with the win.
Have you seen any oil investment money flee Alberta for, say, Saskatchewan or the east of Canada along the coast?
Well, a lot of companies in Saskatchewan are waving their flags saying, we're from Saskatchewan, and please buy our stock. But if the price of oil comes down, they're all going down. The Saskatchewan's government has done the right things and has been very supportive of the industry. My bet is that the provincial leadership here is not going to do anything really stupid. Probably they'll raise taxes. Probably when prices recover, they're going to take more of the upside. When you get above $100 a barrel, corporate taxes will probably go up. Probably we may even see another, fuel tax increase. They've just raised the amount of spending for healthcare and education, which increases the deficit by $800 million. So they're going to have to find revenue to offset that, and or the budget deficit is going to be even worse. So my guess is we haven't seen the full fiscal picture as the government makes its move. But I think the fact that the government quickly said they're not putting in a PST, provincial sales tax. My assumption had been, you put in a 4 or 5% sales tax, then you're just like every other province. You have one. We're the only province that doesn't right now, and that would have generated $3 to $5 billion, which would have taken a big chunk of the deficit away. And the people of the province would have said, we were the only one, and in $100 oil prices we could afford no tax, but now we're like everyone else. But they said no, and their view at the time was it's a regressive tax, so it hurts the poor and the lower middle class more than it hurts other people, and they felt it was regressive, and they want, of course, progressive taxation.
Well, yes, it really does depend on your political stripe on that. It's just like cross-border shoppers here. If you go to Washington State, you pay sales tax. Oregon doesn't have sales tax, but they have state income tax. Washington State doesn't have state income tax. That's why they have so many billionaires who live there.
Yeah, no, every country, every area has to make the decision of, what's the best way longer term fiscally, but also one from a quality of life. And, we've been very fortunate without a PST. Unless oil prices recover in 2016, my view is politically they may be forced to bring it back on the table.
And would that have been the same under a conservative government? I mean, I heard they had something like 27 tax hikes all set to go.
Well, we already saw, tax hikes in the fuel tax, and I think Prentice was planning to raise other taxes across the board and do some spending cuts, but he didn't do enough of either. Like if he'd cut the deficit and shown that he was like Ralph Klein, he wouldn't have lost the right vote. And then I think if he'd shown that he was raising taxes even on the wealthy, I don't know if the NDP would have won. I think what happened was when he didn't do enough of either, he lost the small c conservative vote, and then when he was less than polished in the debate, when he when he negatively commented about her numbers on one of her policies, and then she came back in a very patient and professional manner and argued her point, he looked like a bully. And so, I think people went into the ballot box and just say, we're not giving him the vote this time. Punish him. I don't think anybody's really happy with an NDP majority. I think if anybody, a lot of people might have thought it would have been a minority government, but I think, Prentice's aloofness and the way he handled that debate, I think, punished the Conservative Party for a long time.
What's been the overall opinion of Rachel Notley's leadership?
I think they've acted very professionally so far. I think, they've not done anything, on the loose. They haven't, they haven't shot any, or taken their feet out of their mouth and made a mistake that way. I think the only negative from what I can hear from people who are watching them is that a lot of the senior advisors that are reporting at the minister level are all quite left-wing NDP players from Ontario who have more negative, more left-wing views than even maybe Rachel Notley. So a lot of people are waiting to see if any of these agendas of these individuals show up as the agenda of the government, and then, of course, there might be more of a backlash then.
Yes, Albertans really don't like being told what to do by Ontarians.
I don't think anyone really wants to be told to be by anyone outside of their own. Even when the family tells you. No, I think that the sensitivities here are high, and we don't want Bob Bray government in Alberta. I think that would be something that would shock everybody.
We're speaking to Josef Schachter, president of Schachter Asset Management Incorporated. I'm Jim Goddard. Joseph, is there an attitude in Alberta that maybe the NDP government is less radical on the left and is more of the kind of NDP government you might see in Manitoba or Saskatchewan, where both management and labor seem to get along pretty well because they know without each other, they're both useless?
I think, some of the speeches and comments by Rachel Notley have been of that ilk, so that a lot of people were looking for, right away after the election, oh my God, the extremists have come. And there hasn't been any of that. And I think she's been a very polished politician, and she's come across with the right message. And I think that if they continue on this view, then just like the Saskatchewan NDP is not like the left wingers of Ontario NDP, we may find that our NDP in Alberta, handles themselves as well professionally and businesslike as they are in Saskatchewan. And she may have more life in politics than the one term if she handles this correctly. Remember, the province of Alberta has changed. There's been so much migration, in the 1970s, 80s, and then again in 2000 to in the last year, 2014. Because the amount of growth in oil sands, the refining marketing business in Edmonton, the drilling industry across the province in Alberta, Calgary, you've got the financial, geological, geophysical, talent in the Calgary market, engineering talent here, financial talent here. So there's been a massive migration of people, and the Calgary is the white-collar town, Edmonton is the blue-collar town per se, for the industry. And a lot of those people who came in, came from Ontario and Quebec and Newfoundland and wherever. And I think that's what made the picking so easy for the NDP, is that the province's mix of, from the old cattle right-wing conservative types. The province, has changed in terms of its makeup.
Just getting back to the international scene, some of the biggest oil tanker farms in the world are in China. Just how big are those farms, and are they to the point where they're just about bursting?
Well, China continues to build up. There's hundreds of millions of barrels there, but remember, they're consuming, about 10 million barrels a day, and that's going up by about 500,000 barrels per year. They only produce about 4 million barrels, so they need, 6 million barrels a day. So, if they want to have, 30, 40, 50 days in their strategic reserve, and then probably 30 days in their commercial reserves, if you look at the United States, the U.S. has 101 days, including their strategic reserve, and their commercial reserve is 65.9. That's last Wednesday's data. So the U.S. is now quite high. So, if China continues to build at, 50 million barrels here, 50 million barrels there, and when they do, they're the new buyer, or the buyer at the margin, and that's why, of course, the price held up in 2014, because they had built a new, 60 million barrel facility that came on in the second quarter of 2014. And so while the OPEC was producing in excess during Q1 of 2014, it took into the third quarter of 2014 before prices weakened, because in the second quarter there was a new buyer with new facilities, and until those storage facilities were filled up. There's talk that China will have another 30 or 40 million barrels of strategic reserve ready by the fourth quarter. So when winter comes and demand picks up and this new facility is ready to take excess production, that's when, if OPEC's successful to knocking out 1.5 million or 2 million of non-OPEC production by the fourth quarter, then you could see a nice recovery during the winter of 2015, 2016. As I said, $70 to $80 in the price of oil. But from what low base is it low 40s or low 30s? That's still to be determined.
With low oil prices right now, how can Shell afford to start drilling in the Arctic? That's very expensive.
I think all of these guys are taking multi-decade views. Like the Arctic, we all know there's oil there. During the 1970s, the Beaufort Sea, there were major discoveries by Dome Petroleum in Gulf Canada. There's major discoveries on the Alaskan slope by Arco and BP and others. So we know there's oil up there. The question is, you've got to find enough threshold so that you can justify the massive infrastructure spend. A lot of oil and a lot of gas was found, during the 70s cycle, but we still don't have the Mackenzie Delta pipeline. And the reality is, once you find the threshold financial side of it, then you've got the whole issue of building the infrastructure. And of course, that's when all the issues of environment, First Nations issues, capital availability, all of those things become part of the issues. And of course, Mackenzie Delta got caught up in the tsunami of all those different players, and the bottom line is we never got it built.
I saw that the U.S. oil rig count is up for the first time in 30 months. Do you expect that trend to continue?
Well, again, it matters what's happening with the price of oil. If the price of oil stays in this 50s where we are now, then you might see, more companies look at, some of their opportunities and say, look, I've driven the cost down so that at 50 we make money. But if the price of oil goes down even more, then I think you'll see even more of a rig count shrinkage. That's my bet, is that we break $50 oil in the next week or two. Sometime in the next week, after that, the Baker Hughes weekly rig count will show a decline. We may see another uptick, on tomorrow's data and maybe the week later's data. But if we get into the end of July, into August, and we start seeing the price of oil go to the low 40s, my guess is the Baker Hughes rig count will start declining again.
What about the propaganda war against fossil fuels in North America? Maybe people don't realize that all these movies are financed by countries in the Arab world. So when you see a so-called documentary running down the Alberta oil sands or fracking, just remember who funded that movie and what their point of view is. Is that something the oil industry on this side of the ocean thinks about?
Well, I think everybody is worried about emissions, and we're now beginning to see the government of Alberta raising the taxes for the oil sands. As you remember, just going back about a month ago, they did that because the prior deal had expired. And even the oil and gas industry said, look, we need these so that we can be showing the world that we are, paying for the emissions that we are putting out, and that we are, moving forward on lower use of water. And I think the industry, with the tailing pond issues and all the rest of it, there's a lot of money being spent on trying to use less water, less use of tailing ponds, size of tailing ponds, and having a smaller environmental negative footprint. So, as the price of oil comes down, it makes it tougher because you don't have the cash flow to do that. But my view would be is that longer term we're going to need more of oil sands production. Maybe it'll be SAGD, so it's not these big open mining operations. Cenovus, of course, has a lot of the SAGD, the Curl project by Imperial Oil and Exxon. And so we may see more of that, and less of the big open pit stuff. Because the open pit stuff, is $6 to $10 billion, and then you have an upgrader, and that adds to it. So the entry price to build one of these monsters is facilities is bigger and bigger. While you can do staged effects of SAGD and steam related projects. And you can do them, 10,000 barrel increments. And there's also some new technologies coming around where you can use solvents, and you don't even have to have tailing ponds. So the industry continues to move forward with finding solutions, and and the more cash flow they have, the more quicker they'll get there.
Well, the same thing happened in the pulp and paper industry, where now you have effluent-free mills. No smell, no pollution coming out of a pipe somewhere. And here in BC, how sound? You can eat the shellfish again.
Yeah, no, I think when you put your effort into it, I think we're going to find solutions. And just think about the use of natural gas versus coal. The U.S. and Canada are way ahead of where they thought they would be on the environmental because they're using more natural gas, which is the cleanest burning of all the fossil fuels. And we have an abundance and a very low-cost alternative, natural gas, And that's why, a lot of the coal mines have had problems in the States, and their stocks have been hammered because they're finding it tough to compete against natural gas.
Joseph, thank you very much for being on This Week in Money.
My pleasure.
My guest has been Josef Schachter, president of Schachter Asset Management Incorporated. Thanks to our guests, Ross Clark and Josef Schachter, and thank you for listening. Comments or questions for This Week in Money can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.